In today's video, I'm going to show you an SMA trading strategy that's not based on guesswork. It's built on data and clear mechanical rules. Every trade follows the same structured process. First, identify the direction, then the location, wait for confirmation, execute a precise entry, and finally, manage the exit. No random trades, no emotions, just a disciplined system you can follow every time. To keep it simple, I'll demonstrate the entire process using just two charts. First, we'll use the 15-minute chart to determine the market direction and identify the key trading location. Then we'll switch to the 1-minute chart to look for confirmation, pinpoint the exact entry, and plan the exit. Now let's open the chart and get started. The first step is identifying the directional bias and the trading location. This is our 15-minute chart, and we only need to do two things here. First, determine the overall market direction. Second, identify the exact area where we'll be looking to take a trade. Both of these steps are done on the same chart, which is why we're covering them together. So let's start with the first step, market direction. Take a look at this chart. To understand market structure, we focus on structural highs and structural lows. These aren't indicators, they're simply the natural movement of price. When price creates a high, pulls back, then moves higher and breaks above the previous high, that's called a bullish break of structure, BIS. Take a look at the chart on your screen. Price formed this high, then pulled back to create a low. After that, it rallied again and confidently broke above the previous high. That's a bullish BOS. This tells us that buyers are in control and the market is likely to continue moving higher. Our directional bias is bullish, so from this point on, we're only looking for buy setups. Now let's look at the opposite scenario. If price forms a low, then rallies and later drops below that previous low, it's called a bearish break of structure, BOS. That tells us the market direction is bearish, and on that day, we're only looking for sell setups. The rule is simple, but take it seriously. If your directional bias is wrong, no trading system will perform consistently. Whenever you're unsure or see conflicting signals, always give priority to the 15-minute market structure. Now let's move on to the second step, location. We already know the market direction, but does that mean we should enter a trade right away? No, we only take trades at a specific high probability zone. In this strategy, we use the highs and lows that the market created while forming its structure. More specifically, we focus on the swing low that formed before the bullish break of structure. Take a look at the chart. Before the market printed this bullish BOS, it first created this swing low. That area becomes our location, our point of interest, POI. Why is this area so important? Because it's where the market gained momentum. This is where smart money likely built their buying positions. When price returns to this zone, those institutional buyers are more likely to become active again because they'll want to defend their positions. Now here's an important addition, session highs and session lows. The Asian session high and low often act as liquidity pools. The market frequently sweeps these levels, meaning price briefly moves above or below them, collects stop-loss orders, and then makes a sharp reversal. So when our structural low lines up with the Asian session low, that creates an even stronger high-probability trading zone. That's our ideal location. Look at this chart. Here's the structural low, and notice how it aligns with the key session level. This tells us the area is highly significant. If price returns to this zone, we'll be ready. At this point, our work on the 15-minute chart is complete. Our directional bias is bullish, our location is this high-probability zone, and now all we have to do is wait for price to come back to it. As soon as price reaches our zone, we switch to the second chart. Step 3. Confirmation on the 1-minute chart. Alright, price has reached our location zone. Now we can close the 15-minute chart. This is our execution chart, the 1-minute time frame. But wait, don't enter the trade yet. Just because price has reached the zone doesn't mean it's time to buy. Price can still test the zone and continue moving lower. We need confirmation. A signal that tells us smart money has actually stepped in. That signal is called CHoCH, change of character. Take a look at the 1-minute chart. While price was inside our location zone, what was happening locally? The market was making lower highs and lower lows, meaning the short-term trend was still bearish. But then look right here. This candle broke the previous swing high. That's our CHoCH, a change of character. The 1-minute market structure has shifted from bearish to bullish. This is the exact moment we know that smart money has likely entered the market. The reversal is now confirmed, and we're ready to plan our entry. What we're looking for is a clear structural shift that confirms the local trend has changed. Once we see that, we can move to the next step. Where do we enter? At a point of interest, an order block or a fair value gap, FVG. Now that we have our CHoCH confirmation, where should we enter? This is where many traders make a mistake. They buy immediately at market as soon as the CHoCH candle closes. The problem is that it creates a larger stop loss and a weaker risk-to-reward ratio. Instead, this strategy adds one more step. After the CHoCH, we look for an order block or a fair value gap, FVG, created by the bullish move. Look at the 1-minute chart. The CHoCH happened here. Now focus on the bullish move that created it. The last bearish candle before that rally is the order block. This is the candle where smart money likely accumulated buy orders before pushing the market higher. Now notice this gap between the candles. There's no overlap between them. That's a fair value gap, FVG. Price moved so aggressively that this area wasn't fully traded. Here's what we do next. After the CHoCH, price often makes a small pullback. That pullback usually returns to the order block or the fair value gap. That's where we place our limit order. Take a look at the chart. The CHoCH formed here. Price pulled back to fill the FVG, and our limit order was placed right around the middle of the fair value gap. The entry was precise. Our stop loss goes just below the low that created the CHoCH. This approach is powerful because it keeps the stop loss tight, which gives us a much better risk-to-reward ratio. Step 5, trade management and exit. Now we're in the trade and our stop loss is in place. Let's talk about the exit strategy. In this system, we divide the exit into 2 parts, making the entire process structured and systematic. The first target is 5R, meaning 5 times your initial risk. For example, if your stop loss is 10 points, your first target is 50 points above your entry. As soon as price reaches that level, close 50% of your position. Take a look at the chart. Here's the entry, here's the stop loss, and here's the 5R target. When price reached this level, we locked in profits on half of the position. At this point, the trade is already profitable, and our overall risk has been significantly reduced. Now, for the remaining 50%, move your stop loss to break even, your original entry price. From that moment on, the worst-case scenario is no loss. Now let the remaining position run toward a larger target. This gives you the opportunity to capture the bigger institutional move, where liquidity often attracts price. Look at the chart again. Price reached the 5R target. We took profits on 50% of the position, moved the stop loss to break even, and then held the rest until the final target was reached. Here's the final exit. The initial risk was only 10 points, while the combined reward was significantly larger. Bonus tip. If price shows clear weakness before reaching the 5R target, such as a strong bearish candle or a bearish structural shift, don't hesitate to close the entire position. Protecting your capital should always be your first priority. So that's the complete strategy explained in 5 simple steps using just 2 charts. On the 15-minute chart, we identified the market direction using the break of structure, then marked our trading location using the structural level and the Asian session level. On the 1-minute execution chart, we waited for such change of character as confirmation, entered at an order block or fair value gap, FVG, and used a tiered exit strategy to maximize profits while controlling risk. This strategy isn't complicated. The key is to follow the exact same process consistently on every trade. If you found this video valuable, hit the like button, subscribe to the channel, and I'll see you in the next video.